Hi, welcome back to the channel. I'm Eugene Day. Today, I want to talk about the way that the manner in which we conduct financial management of hospitals actually undermines a lot of important ways that we could improve care. Now, I'm not a CPA, but I have seen and worked with many people in the financial space within hospitals, and there are some common problems. Not every CPA is like this, but there are some common problems that I have seen across institutions. And I think we probably see it in other institutions as well and businesses in general. But very specifically in hospitals, there's a common problem related to how we manage the flow of money through the system that results in bad clinical decisions being made and bad operational decisions being made that result in hospitals that cost more and operate less efficiently than is necessary. Finance people are by nature reductionistic. That means that they're detail oriented. They look at small subsystems. They ensure that money is flowing through each of those subsystems in the correct way. And then they assemble all those together to create a financial picture of the overall system. This is really important, and it's a good way of doing things when you need to keep track of every penny, and these hospitals do. But it also biases them towards some fundamental failures that are really important on a macro level when you think of things the way a systems engineer thinks of things. So, reductionism is the tendency to break systems down into very small pieces and to study those small pieces in order to study how they work and understand how the overall system works. The opposite of reductionism is holism, or a holistic view of systems. And as a systems engineer, what we have demonstrated is that you cannot understand overall system outputs and outcomes by examining the constituent elements. We've talked about this before. You can't understand how an ant colony works just by studying the ants themselves. You have to study their interactions and the complex ways that they communicate. And the same is true when it comes to how money flows through a complex system like this. Without getting too deeply into it, the way that accounting is done in hospitals, and again, I'm not a CPA, but I have managed these cost centers, is to break the budgeting down into individual cost centers. Each cost center is given an annual budget and an annual set of things that it needs to pay for, and those have to match up reasonably well. It's a challenging process, and figuring out exactly how many people have to be paid from each cost center and how much equipment and other things like that. It's complicated, and there's a reason that people specialize in how to do that. But the communication between cost centers is rarely focused upon, or if it is, they are rolled up to a unit level financial report and budget. So, for example, an emergency department might have two or three different cost centers, but the emergency department itself has an isolated financial unit that is analyzed for budgetary purposes. And the same is true for IT, right? The IT department has dozens and dozens and dozens of cost centers, but IT itself has one large scale budget, which filters down into those cost centers. And the accounting at the cost center level or at the unit level betrays the hospital in important ways that CPAs and financial leaders in these complex systems rarely think about. And it's not too complicated for them to think about. It's not that it's beyond them, it's that it's not the way they're trained to think about money. And so units within the hospital or cost centers within the hospital are generally sort of colloquially designated as either revenue generating or non-revenue generating. So in a hospital, a revenue generating unit is like your emergency department or your cancer ward, right? They see patients, they bill for the services. Whereas performance improvement or IT is non-revenue generating in the sense that they are a cost that the hospital has to bear in order to do their business. And non-revenue generating cost centers are then often extraordinarily pressed to do the best they can with the least amount of money because it's seen as essentially waste. it's the necessary cost of doing business, but if you can do it cheaply, then you will be more profitable, or so the theory goes. That theory is almost invariably incorrect, and it costs a lot of revenue and it costs a lot of lives to think about hospital performance that way. So, to explain what I mean by costing revenue and lives to think about hospital performance that way, I want to talk about a story from a hospital that I once supported. And they were in the process of building a behavioral unit. They wanted to know essentially, how do we build this medical behavioral unit that will be profitable and that will take care of the patients that need behavioral services? So they ran all these numbers and they wanted to build a 16-bed unit. And they believed that, I'm going to make up some numbers, but that these beds could bill at, say, $1,000 a day. Now, you build a 16-bed units, you can bill it $1,000 a day per bed, $16,000 a day. It's a few $1,000,000 a year. It's going to lose money. You cannot staff that unit in a way that will support the financial health of the unit. And so, from a cost center accounting perspective, it's not worth it. You don't do it because you're going to lose money every month, guaranteed. So, they asked me to look at the system and to see if I could find any better information about what this unit would do and if there was any way to make it profitable. And what I did as a systems engineer is to think, where are these patients coming from? The answer to that is they were coming from the inpatient areas of the hospital. This was for patients who were medically ready for discharge, but for behavioral reasons. So, for example, a patient that is a danger to themselves or others could not be discharged. They can't bill when they're in the inpatient areas if they're medically ready for discharge. There's no treatment being undergone that justifies sending a bill to an insurance company or to the state. So they're occupying a bed in the inpatient areas and they're billing at $0 a day, and that bed costs, let's say, $3,000 or $4,000 a day to staff and manage. But if you can decant that patient to the behavioral unit, where now, because they're receiving behavioral care in a behavioral bed, they can bill at $1,000 a day. It's not enough to cover their care, but it's a lot more than nothing. Still, alone, that's not going to generate enough revenue to justify the new unit, except for the fact that now they have emptied an inpatient bed. And that inpatient bed can bill on average, let's say, $5,000 a day, often much, much more than that, for a patient that actually needs inpatient medical care. Now you have, instead of $0 a day, you have a patient in an appropriate bed, you have a new patient in a medical bed, and you're added $6,000 a day to your hospital's billing. Cost center accounting will never detect this, right? It will never understand that $1,000 a day bill in the behavioral unit that you can make, even though you're actually losing, say, $1,000 a day because it costs $2,000 a day to care for that patient. The revenue generated at some other cost center is enough to more than justify the cost associated with the medical behavioral unit. So this is the way that traditional cost center accounting fails hospitals. And when I say it costs them revenue, we can see that's $6,000 a day that they weren't making. It also costs lives. Not only do you now have a new patient in a medical bed who is receiving the treatment that they couldn't receive before, but you have a behavioral patient receiving appropriate care instead of inappropriate care in an inappropriate bed. And so the public health outcomes are fantastic, the revenue outcomes are fantastic, and all of this gets excluded by cost center accounting when it is done naively, which it sadly, in my experience, usually is. And it's not just these specialty units. We see emergency departments being closed because, from a cost center perspective, from a unit accounting perspective, they don't appear to be profitable. But what you neglect when you shut down that ED is all of the patients that are brought into your ICU, which are billing on average more than $100,000 per admission. You lose the patients that are coming to your operating rooms, even just your regular admissions. The ED is a massive front door to your hospital. And even if it is losing money, you have to consider the value of that ED and the value of those patients as those patients move through your entire system. And cost center accounting and unit level accounting often fails to do this. And even when the financial accountants at the top get it, they often want to squeeze those departments that are seen as negative revenue. They want to do things as cheaply as possible, and they don't recognize the long-term whole system costs of care. As a systems engineer who can model the flow of these patients through the system, I have the ability to examine the entire revenue stream from tip to tail that financial modeling often neglects, and to understand those complex interactions between various areas of the hospital and the financial stewardship of that medical facility. So I'm not here to just piss on accountants. They do an incredibly important job, and most of them are incredibly bright people. But the the structures that we have built around healthcare accounting bias them towards myopia when it comes to analyzing the full financial health of these systems. So I hope you've enjoyed my little discussion today. I would love to hear more about what you think about hospital care, hospital accounting, and I think, as YouTube does, that you're going to love this video right here. Come back next time, and I'll talk to you soon.